If I had to pick one stock today from scratch, knowing what I know about the software panic, the AI headlines, and the way Wall Street loves to price in the end of the world before breakfast, I would not be hiding in the safest corner of the market. I would be staring right at the stock most people are too nervous to touch. Because sometimes the opportunity is not the company everyone agrees on. Sometimes it is the one everybody has already sentenced. And when that happens, if the business is still executing underneath all that fear, that is where lives can actually change. It is Wednesday, April 15th in New York, so comment below with the day and date you are watching from. And by the way, if you value my work, support the channel by subscribing and commenting John A.G. Best. That really helps more than you know. Now, I want to be very clear right up front. This is not one of those stories where I tell you everything is fine, the market is dumb, and every beaten down software name is magically a winner. No. Some of these businesses are going to get clipped, some are going to have to rip up their pricing models, some management teams are going to discover that talking about AI and actually shipping AI are two very different things. But that is exactly why this gets interesting, because when fear gets broad, the market stops separating the weak from the strong. And from recent market updates, that broad fear has been real. The software group has taken a real punch this year. The main software index is down by roughly a quarter in 2026, and investors have been dumping names across project software, design software, security software, back office software, you name it. The reason is not subtle. Faster AI models and more agent-style tools have pushed a simple question to the front of the market. If software used to help people do the work, what happens when software starts doing the work for them? That question matters. It really does. And I do not want to cheapen it with fake confidence. Anthropic itself described cowork as moving from asking questions to actually getting work done alongside teams with real workflows like document creation, research synthesis, and data extraction. So yes, the threat is real, the productivity shift is real, the pressure on old seat-based models is real. Anybody telling you none of this matters is asleep at the wheel. But here's where I think the market is making the classic mistake. It is treating all software like a flimsy little wrapper that can be replaced over a weekend. And that is not how the serious part of enterprise software works. The first layer is the flashy layer, the demo, the prototype, the thing that looks incredible on social media. The harder layer is the one underneath. Permissions, workflows, handoffs, integrations, record keeping, audit trails, security reviews, admin control, adoption inside teams, and all the messy human behavior that lives inside real organizations. That is where the sticky value usually sits. That is also why a lot of enterprise software does not die as fast as the timeline says it should. And that brings me to the stock, the one I think the market is still reading the wrong way. The company is Monday.com. And no, this is not about the name. It is about what the business has quietly become while a lot of people were only looking at the chart. This is a company that started as a flexible work platform and kept expanding outward. Not just project coordination, not just team boards. It has pushed into customer management, product and developer workflows, service tools, automations, dashboards, and now AI features that are meant to sit inside the existing system rather than blow it up. Based on recently published numbers, the company finished last year with more than 250,000 customers, net dollar retention around 110%, and more than 4,000 customers above the $50,000 annual recurring revenue mark. Even more interesting to me, the very large customer bucket kept growing fast, with customers above the $500,000 annual recurring revenue level jumping sharply over the course of the year. That is not the profile of a platform that is quietly getting abandoned. That is the profile of a platform working its way deeper into larger organizations. And the income statement tells a story too. Fourth quarter revenue grew by about a quarter year over year. Gross margin sat right around the high 80s for the quarter and around 90 for the full year. That matters because high gross margins buy you time. They buy you optionality. They buy you the right to invest when weaker competitors are forced to retreat. If AI changes the game, and I think it will, I would much rather own the company that already has customers, already has cash generation, and already has room to spend on product than the company still trying to prove it deserves to exist. Now, could the market still push this thing around? Absolutely. Could the stock still look stupidly cheap and then get cheaper? Of course. The market does not care about your timeline. But that is not the same as saying the business is broken. In fact, one of the strongest signals here is that Monday is not standing still waiting for the future to happen to it. The company has been talking openly about monetizing AI capabilities, expanding products inside the base, and leaning harder into larger customers with more support resources. In plain English, management is trying to turn AI from a headline risk into an upsell engine. And here is the counterpoint, because I want to be fair. I do not buy the idea that every workflow platform is automatically protected just because customers are already there. Switching costs help, but they are not magic. If agent tools get good enough, some categories will compress. Some feature sets will get bundled away. Some products that used to command premium pricing will become just another layer in the stack. That is why I am not giving you a fairy tale here. The bet is not that nothing changes. The bet is that Monday changes fast enough, and that its existing footprint gives it a much better shot than the market is willing to admit. That is also why I like this setup more than the lazy hot take version. The lazy version says software is dead. The other lazy version says AI makes every software stock a buy. I think both are nonsense. Goldman Sachs has argued that agents could become a huge share of the software market by the end of the decade, but it also says the total market can still get larger. That is the key. The profit pool may shift, the interface may shift, the winners may shift, but the idea that software value just evaporates, I do not see it. I see reallocation. I see compression in some places and expansion in others. And that is a very different game. This is why I think Monday has real asymmetry here. You have a business still growing at a healthy clip. You have enterprise traction getting better, not worse. You have margins most companies would love to have. You have multiple product doors into the customer. And you have the market acting like the company forgot to show up to the future. Meanwhile, one of Monday's newer offerings became the fastest product in company history to get past the first meaningful recurring revenue milestone. That does not prove the whole thesis. But it does tell you the company can still launch, still sell, and still find demand even in a market that has become deeply suspicious of software stories. And I want you to notice something else. When fear is everywhere, people stop doing the boring work. They stop reading filings. They stop looking at customer mix. They stop asking whether the installed base is stable. They stop asking whether the company is profitable enough to fund the transition. They just zoom out, see a broken chart, and assume the business is next. That is how serious opportunities are born, not from comfort, from confusion. Now, one more reason I think this story has people leaning the wrong way is the difference between usage and ownership. A lot of investors hear agents and immediately assume the app layer disappears. Maybe parts of it do. But in a lot of cases, the value may move to the platform that already owns the workflow, the permissions, the templates, the human approvals, and the system of record. If an agent completes a task inside the environment you already trust, that can strengthen the platform instead of weakening it. And Monday has been building around automations, integrations, service, dev, CRM, and AI inside one broader ecosystem. That matters more than the market is acting like it does. There is also a balance sheet angle people overlook. When a company is still putting up growth, still generating cash, and still widening its reach into larger accounts, it has more room to make mistakes, to experiment, and to reposition than a company already fighting for survival. Monday finished the year with strong profitability and cash generation, and that gives management a much wider strategic lane than the average story stock pitching some future dream. In ugly markets, survivability is underrated. The companies that can fund their own pivot are often the ones still standing when the excitement burns off. And maybe the biggest tell of all is this. Even after all the panic, the company's larger customer retention stayed healthy, and the customer mix kept tilting upward. That suggests people are not just testing the product. They are standardizing around it. They are embedding it. They are spending more over time. That does not eliminate disruption risk, but it does tell you the market's easiest narrative may not be the truest one. If you are successful, share your success story in the comments so others can stay motivated. Now, before we move on, I want to say one more thing about the broader sector. There is a reason I am not dismissing the sell-off as pure stupidity. The market is reacting to a real shift in how work gets done. Reuters reported that investors have been repricing software stocks on worries that AI tools can automate human tasks and pressure legacy businesses. And you can see that panic spreading beyond one or two names. So yes, there is smoke here. But the market's habit is to jump from smoke to total demolition. That leap is where I think the mispricing lives. And remember, the best setups rarely feel comfortable in the moment. They feel noisy, they feel arguable, they feel early. That is why the payoff can be outsized for patient investors when the facts hold and the crowd's favorite story starts to crack. So if you asked me what kind of software stock I want in this environment, it is not the most exciting demo. It is not the loudest promise. It is the company with real customers, real expansion, real retention, real economics, and enough product breadth to adapt as the ground moves under it. That is why Monday, to me, stands out. Not because it is risk-free, because it is misunderstood. All right, I also need to tell you that the next part of this video is sponsored, and I always want to keep that clean. The company is Medicus Pharma, ticker MDCX, and this is a completely different setup from the software discussion. This is not a mature operating platform. This is small cap biotech, which means the upside can look huge and the risk can be brutal. So keep that frame in your head the entire time. What caught my attention here is the medical problem they are aiming at. Basal cell carcinoma is the most common form of skin cancer, and American Cancer Society data says the common non-melanoma skin cancers add up to more than 5 million cases a year in the United States. The National Cancer Institute says basal cell carcinoma rarely spreads, but it is still the most common form of skin cancer. In other words, this is usually not the scariest cancer headline, but it can still leave people dealing with treatment burden, repeat procedures, and visible scarring, especially when lesions show up on the face or other exposed areas. Medicus is trying to approach that with a microneedle patch format that delivers doxorubicin directly to the lesion. The company reported top-line Phase 2 data in early March, describing the study as a randomized, double-blind, placebo-controlled, multi-center trial with 90 patients. Management said the top-line data were strong enough to support an end-of-Phase 2 meeting with the FDA in the first half of this year and to help move partnership discussions forward. Those are interesting milestones, but they are still company-reported milestones, and that distinction matters. There is also a second piece to the story. Through the Antev acquisition, Medicus has exposure to tevorelix, and the company says it received FDA clearance for a Phase 2b study in advanced prostate cancer patients with high cardiovascular risk. That study is designed to enroll 40 men. And if you know anything about tiny biotech, you know exactly what I'm going to say next. Pipeline breadth sounds great until cash burn, trial risk, regulatory delay, or disappointing data remind you why this corner of the market is not for tourists. So here's my bottom line. On Monday.com, I think the market has taken a real threat and stretched it into a story that may be too dark for the actual numbers on the ground. On Medicus, I think there is an interesting medical and regulatory story, but it belongs in the very high-risk bucket until proven otherwise. Two completely different names, two completely different types of risk, but both worth understanding for very different reasons. And that is the whole game, isn't it? Not just reacting to price, not just reacting to fear, understanding what is actually breaking, what is merely changing, and what the crowd may be misreading in real time. That is how you give yourself a chance to be early without being reckless. As always, this is for education and discussion only, not financial advice. I am just walking you through how I see the setup, where I think the market may be confused and where the risks still live, so please do your own homework before you put a single dollar to work.